and I will, as an organization, we are working on material that we can provide not only our realtors and centers of influence, but clients as well, just so they have a better understanding. But absolutely, yeah. This is the horse. just to be clear. No.
Thank you.
Yeah, great question. Yeah, so again, I just mentioned there's been a number of monoline lenders that have exited specific programs. That's, we think, where the biggest change is going to come, is that you'll have a lot of monolines. Right now, we've already heard that on the investor market, some of them literally stopped when this announcement came out the next day. Within 24 hours, they pulled immediately. If you look online, it says suspended. So, you know, and when it comes to refinances, there's some that are saying, yes, we'll still continue to do them. However, we're going to charge this much more as a premium because we're not quite sure what it's going to mean to us in the future. So that's the big part that we want to make sure we're trying to keep an eye on. So again, the biggest changes that if we can summarize every single one of these changes, it will result in a higher cost of borrowing for everybody, regardless of where you are or what, if it's insured or if it's not. The difference between the overnight rate and the bond rate and what the sale rate is at the end of the day, that's what's going to increase. So we will see. You know, I don't know how many of you follow the overnight rate or the bond rate. Quite frankly, I don't. But that's generally what drives banks to adjust interest rates. That's not going to be the indicator as often any longer. It will be it'll be what the sale rate is, but what the spread's going to be between all of those, so we can make sure that the cost of borrowing is included in there as well. So not just us. That goes for the monoline lenders as well. And the biggest reason is the inflationary cost to the capital due to the lack of movement. So with monoline lenders, where they're excuse me, buying the bulk insurance on the outside, they're trading that. Okay, so they're increasing their portfolio value by trading that money in the open market. That's why typical financial institutions like ours or any of the other big ones, we don't do that because we lend based on our balance sheet. So you'll see that from our end of things, with some of the changes that are coming through, or any bank, not just us, the cost of capital going up. Same idea for mono lenders, because now mono lenders cannot resell their insurance portfolio afterwards. Okay, so that's around the, and then what's on the topic right now that there's a lot of question marks around is the lender risk sharing. And that was touched on briefly, and that's what's coming, and that's what the discussion is right now. And the easiest way to summarize that is you think of your deductible with any of your own personal insurance. So if you have a claim and your deductible is X, you have to pay X before the insurance company will pay out Y. And that's what the government is in conversations with now with all lenders. And we don't know when that'll come down, but it's the chances of that coming down is quite high. And what does that mean? Increase of cost of lending. And that's just the way that the world goes around, I guess. So I'm not sure if you have any questions on that. That one's still the one that's up in the air. But if you do have questions, again, I can try to answer them, and if not, we can certainly take them away. The biggest one that seems to be on the minds of everybody is the change in the 5-year qualifying rate and how that's going to affect. So I guess the easiest way to explain it is if any of your clients had a firm approval, and what I mean by that is an insured approval dated October 3rd or previous, they're fine. There's no changes. Just the advice that you need to give them is don't touch your application. Don't touch it. Don't do anything. Don't make any changes. Don't think you want to add something else on because then it will be subject to the new rules. Any applications dated and approved, and I say approved not by us, by the insurer. So there is a difference, okay, whether it's with us or with any other financial institution or broker, it needs to be insured approved. Any dates between October the 3rd and October the 16th, providing it funds by March the 1st, is fine. It's based on the sale rate, which right now is, yeah, we have a question from the crowd.
Yes, I just want to make sure that I'm going to ask you to clarify that approved by the insurer typically means there's an agreement of purchase and sale with it, not a pre-approval. Right, but I want to make sure you guys understand the difference. When you're thinking you have a pre-approval that's firm before October 3rd, it's a pre-approval accompanied with an agreement of purchase and sale that has been submitted to the insurer.
Approved.
Right, and approved by the insurer. Not just a pre-approval that the human can go spend X amount of money. because that wouldn't have gone through the insurer yet. Thank you.
Thank you for your question. So is that clear for everybody in the room? Pre-approvals, it quite frankly, it's not worth the piece of paper it's written on right now. And that's the challenge, you know, because again, so to clarify, I think I covered off if it's before October the 3rd, everything is fine. Between October the 3rd and Deborah's handing out just a quick sample, it's not true numbers, obviously. The Bank of Canada rate is the right amount, but anything dated between October the 3rd and October the 16th, provided it is insured approved, still needs to be bank approved, but make sure that it's insured approved, and funds before March the 1st, it's based on the sale rate. There's one in every crowd. After October the 16th, it's the new rate. Yeah, Brenda? I'll repeat.
Now with that same buyer, we have a smart rate higher.
Yeah.
How much of that drop that they did? Wait, we have to repeat the question.
Yeah, hang on, hang on, guys.
We have to repeat
I'll
Wait, you guys, let the question be repeated for people online.
So the question from Brenda Kay is if there's a pre-approval for X and they've been told that they can go spend whatever that amount is, what is the average that it's going to drop by based on the new benchmark rate or the Bank of Canada rate of 4.64? And quite frankly, it depends on the client. That's the right answer. It's going to vary depending on their down payment. It's going to vary depending on their income. Everything is going to change. I think the language or the terminology that I wrote when I was looking through here this morning, let me just make sure I get it correct. It's not going to be significant, but it will be measurable, is the biggest. And again, if it's a pre-approval is just a pre-approval, right? So you have to now go back and look at the benchmark rate. Absolutely. Yeah. 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 Just a sec. I got there. Yeah. So Brenda's comment there was just to make sure that you're giving the advice to your buyers to make sure they're going back. Especially if you're out pre-approved or the client is pre-approved and you're out shopping looking for homes in a certain price point, it may affect what they can actually qualify for. Now, if their TDS was fine, it might not make that much of a difference. But if they're pushed up against it, absolutely it's going to make a difference. Yeah. So we do have some examples that Deborah will share later as well, and we can provide that. We're trying to, again, as an organization, we're trying to scramble, quite frankly, to get some of this stuff out to everybody. And as you can appreciate, anything that we share needs to be scrubbed diligently over and over and over again, just in the event it lands in the wrong hands. We need to make sure that we're covering everything that we are supposed to and not saying anything detrimental or anything that's incorrect.
Good question. Is this according to less than 10%?
Yes.
So say yes to.
Yes, Bridget. It affects everybody that's in a high ratio position currently.
Also, it's not only CMHC, it's any default insurer. Also, there are some programs that have to be default insured, like a mini home purchase. No matter how much they're putting down, it doesn't matter if it's even 20% down with them. If they have to be default insured, they still fall under the new rules of qualifying at the board rate rather than the contract rate. Also, purchase plus improvements.
Deborah's using her inside voice. Sorry, Deborah's using her inside voice and talking to me. Well, you just have to, so just to summarize, she said that all mortgages that are default insured, so not just CMHC, but using the other insurers, but also there are some properties that are required to be default insured no matter how much you put down. So a mini home purchase on leased land is required to be insured even if you put 90% down It doesn't matter. So it still has to go through an insurer, so it would have to be at that higher rate. Also, purchase plus improvements, even if you put 20% down, it's still required to have default insurance. Therefore, you wouldn't get past that that benchmark rate either. Okay. If someone has, so Brenda's question was, if someone has more than 20% down, do they get the lower rate? Get qualified at the lower rate. My understanding is yes, as long as it's not, doesn't fit into one of these categories. Yes.
That could change.
Yeah, yep. You guys are all jumping ahead of me. Well, that's fine. That's fine. Just kidding. Part of what Ann just mentioned is, what about sellers that are currently trying to sell, that have a price point in mind? You know, so if their house is sold or is in the process of selling, they have a feeling they want to make X so they can purchase Y. Again, your biggest piece of advice that you can give is to speak to your clients immediately. We're trying to do the same thing with a lot of our pre-approvals, trying to turn them into approvals so the clients won't have to worry about that. And again, everybody's under the gun. I did have a meeting with CMHC yesterday morning, and they will work with lenders based on the received date, because they feel that they're going to have a pretty big influx of applications coming in. Now, I can't speak for Genworth and I can't speak for Canada Guarantee, but from CMHC's perspective, they're going to look at the intake date and then see what their backlog was. And if their backlog is quite heavy, but if it was received by the date, then they're going to do everything they can to honor the received date. So again, so if you're selling, or one of your clients are selling and they have a thought process, you're best to jump on top of that. And you know, it's the same message that I'm trying to give my team. We need to talk to realtors. We need to talk to our clients. We need to talk to a lot of people, because if we're not, somebody else will be. And it could be their friend at the coffee shop that says, well, I heard this or I heard that, and it's nowhere near correct. But all of a sudden, panic's going to set in. And I think that's, you know, you guys are an extremely professional organization, and obviously one of, if not the best, in Atlantic Canada. And that's part of your value proposition that you want to bring out to your clients as well, the same way that we want to do. The biggest issue that we're seeing right now, and the biggest question mark, is around long closings, constructions, condo projects, things like that. So if you currently have a client that is in approved, firm approved, insured approved, prior to October the 3rd, that has a closing date after March 17th, please tell your client not to change a thing. Nothing. They can't say, well, I need to spend more money. It can't. After March, what did I say? 17. Oh, sorry, March 1st. Sorry. Yeah, 2017. Sorry. Thank you, darling. If they do, automatically they're under the new rules. So if you think the way that we typically do, and you're getting close and you think, oh, maybe I could spend a little bit here or a little bit more here, or maybe I can change this and do this. If you change, for instance, you're not going to put in the mudroom anymore, you're going to rewire the house with upgrade wiring, it's going back to the insurer. Just like that. And you might not think of, even if it's a $10,000 for $10,000, doesn't matter. It's going back to the insurer. Okay, that's a very little known fact, because typically that's done behind the scenes. So we would do that behind the scenes. And I'll give you an example. We had a deal we were working on last Friday, and we couldn't get the client had provided, and I don't want to point the blame at the client, but they provided the wrong interdebit memo number. We only found this out late Friday night, so we couldn't change it. So Monday morning we changed it. Obviously we couldn't close on Friday. We changed the closing date, and we're right back to CMHC just for a closing date change. Yeah, not always, yeah, but that's the risk you don't want to take, right? So if there's any, I'm telling you, if there's any changes to your clients, they're at risk of being repriced with the qualifying rate, and that's the last thing that you guys want. It's certainly the last thing that we want. So there's a lot. I mean, in our market in particular here in Halifax, just take a look around the cities. Right around the city, you're going to see all kinds of cranes and all kinds of condo projects, and we have a ton of those condo closings going on right now. So you can imagine what's happening into next year. So make sure that you're providing the right amount of advice around what that could mean if they decide to make any changes.
Yeah, that's what I was just about to ask, like with new construction too, because closing dates can change. So are they going to do anything with that?
That's the unknown, to be quite honest. I'm not sure who asked the question, but a great question, Kelly. And that's part of what we're still trying to dig into. And again, I listened to our national call 3 times since I was on it live, and that's still the one question that nobody really has the answer to. Is, you know, you get to, if you look at some of the condo projects that are just starting to close over the next week or two downtown, that were supposed to close in August. You know, with a change in closing date, is that going to affect the approval? And we don't know the answer to that right now. We're waiting for the government to get back to every one of us. That's the tough one on the loan. Anything after March 17th, sorry, March 1st, 2017. Absolutely, yeah. I'm Irish, right? That's what it is. Yeah. I'm gonna get my exercise.
Does this change affect only deals that are live now, or that you can do an amendment on, or is that deals that become effective after October 17th?
Both. So if the deal is live and approved now, and you make an amendment change, that could trigger it going back to the insurer. So if it does, so after October 16th, if you start an application on October 17th, or we do, or a financial institution, it's on the new rules anyway. So you're at the qualifying rate at that point. Now, keep in mind, for anything, you know, the 1, 2, 3, and 4 year terms that we're seeing a lot of in our market, it's been at the qualifying rate anyway. And 5 year variable, it's been at the qualifying rate anyway. So people might not know that, right? That if you're talking with your client, you don't always necessarily know what rate or term that they're looking at getting into. So if they could be purchasing a 3, right now the 3 and 4 year in particular are very, very competitive. So we're seeing a lot of clients go that route anyway, especially over the last 6 or 7 months. So they're not going to be affected at all. They're already at the qualifying rate.
So for 4 year, those are variable and they're at 2.59.
So Brenda Kay's question was a 4 year closed or 4 year variable. There's no 4 year variable, so 4 year closed. Okay. So their rate now, their paying rate or their sale rate might be 2.3 as an example, but they have to qualify at 4.64 now. They always have. So anything less than a 5 year term has always been at the qualifying rate anyway. Yeah. Susan.
So essentially you're saying the best advice to give clients, even if we have a firm deal, is, I know it'll be an influx to the mortgage specialist, but is to talk to their mortgage specialist, because that's to me a big red flag, is no changes, because new construction is typical for doing changes after you upgrade your flooring and you add $3,500 amendment on, or the builder is delayed 2 weeks and you change the closing date.
No, you're absolutely right. We want to make sure you're driving them, whether it's us or whether it's their own FI. I mean, at the end of the day, we want to make sure that your clients are looked after and receiving the right amount of advice. Once we have more clarity, specifically, I think the question is, if you have a firm deal, a firm builder deal today that's insured today that closes in 2018 and there's changes, can we go back to when it was firm approved if the changes are minimal? And I think that's the question we're still waiting for an answer on. That's right. Yeah. Derwin? Yep. Derwin's question is when financial institutions will have, I guess, all the right answers, especially around their long closings. I think we're pretty clear on the other stuff, but it's around the long closings, and quite frankly, I don't know. You know, when we had our national call, what's today? Friday? On Tuesday. Wednesday. Sorry. That was the big thing, that they're gone back. They're seeking clarity questions, and he said, as you can appreciate, their phone lines are burning up right now with MLAs and with everybody else calling in. Excuse me, especially again around places like ours here that we really, I don't think, needed any changes in our market and in a lot of markets. But yeah, the moment we have them, I spoke with, again, I met with CMHC yesterday. They have a meeting this morning, And they said the moment they have some clarity that they can provide me, they'll send to me. And then I'll turn around and I'll send it out to Sean to make sure that you guys are receiving it here as well as soon as I have it. Our regional sales coach with Kay Kelly, she's on her national call today. Any information that she has that we're able to share, you guys will be the first group that we certainly send it out to, for sure.
But Derwin, to your point, at least if you send them back to the bank, we can do the stress test and say this will have no impact on you because you qualify at the new rate regardless. So at least it's peace of mind, right? Versus that very small percentage of the population where we have to say, okay, we did have you qualified at a 5-year fixed closed term, so there could be an impact. Then at least they're aware about making changes.
Any questions in the room, online? Yep. No other questions before we do that? We're good? Okay.
Okay, so I just want to clarify a couple of things. We're going to have Deborah do a couple of math pieces, so I'll have her tell you out loud what she's doing. We'll take a picture for the people that are online and send it to them because our video streaming, Aaron, I'm assuming, is not up right now. It'll be a little complicated to set up right this second. One of the things that I want to make sure everybody also understands from the real estate perspective is that CREA was also not consulted. So nobody in organized real estate was consulted. So CREA and the lobbyists and the Government Action Committee and all of those people are also having all the same phone calls with the housing ministers and with government and everything to try and understand, you know, the role and rule as to how that's working. So I don't want you to think that your organization, you know, dropped the ball on this either. So if you do have concerns or comments, this is something that you would voice to the Political Action Committee at NSAR or to our CREA representative, which is Roy Milley, who is the Atlantic Canada CREA representative. So if you have concerns and questions, this is also an opportunity. I know we had NSAR in here a while ago who encouraged everybody to sign up for RAN. Does everybody remember what that is? It's the Realtor Action Network. So it's on Realtor Link, and what it is an automatic connection that when they send out a call to action, you basically click accept, and a letter is directly sent from you through CREA to your MLA to represent at the federal level. So there will be calls to action going out in terms of things that they want to have happen with respect to this. It takes less than 2 minutes to register online on RealtorLink to be a part of RAN. That's how CREA accomplished having, you know, all the work we did to change the consumer price indexing towards RSP draws of the home buyers plan and increasing that. That all happened through the lobbying of CREA. But it's very powerful when you have, there's 130,000 realtors in Canada. So if 130,000 letters went to the housing minister, that would be very powerful. You have a voice to have action as further changes are made through this, and that's your easiest way to do it. Okay, so please take a minute and log on to RealtorLink in order to have that happen. So Holly's question is, so to be clear, the qualifying rate will not necessarily be the rate they pay.
It will not be the rate they. It will not be the rate they pay. Talk to the world.
Okay, so I'm going to have Deborah do a little bit of math for you to try and clarify some of the questions on how this may affect your buyers and sellers. So one of the things, just as Deborah's doing that, I'm just going to mention quickly. So as your broker and with respect to your fiduciary responsibilities to your buyers and sellers, it's extremely important that we do not stick our heads in the sand and assume that all of our clients are fine and that they know what they're doing or that they're paying attention to how this may impact them. Imagine if you have somebody listed, you sell their house, and then plan to go take them shopping to discover they cannot buy a house, and you have sold them out of their house. That is your responsibility because you're informed. So you need to have conversations with your sellers to be sure that they can actually do what they intend to do before you have a family living in your basement. because that's what's good. You're going to feel so horrible. That's what's going to happen. Okay. You need to be absolutely in front of this. You will thank you later. Maybe they wait. I'm not going to pretend you may have people who have to stop listing. I will be lying to you if I said that's not a possibility. But as they get themselves financially in order, they're going to come back to you because they're going to respect the fact that you absolutely looked after them in front of your interests. You're going to have lots of clients where it doesn't make any difference because they're not anywhere near their maximum purchasing rate. They've got more than 20% down, et cetera, et cetera. There's going to be lots of people that are fine. But how awful are you going to feel when you bring them an offer and you, in the back of your mind, aren't really sure whether or not you should do this? If you're working with buyers, it's the same thing, that you need to be sure that they have checked with their financial institution to be sure that they actually are good to go before you put pen to paper and you have a buyer spending money on inspections or giving notice to get out of a lease. Okay? So please make sure that you do that. We're going to talk as soon as Deborah's done about some opportunities that exist in this news in terms of how you can build your business. So I'm going to just turn it over to Deborah.
I have to change markers here.
Change markers. Okay, so I'm just going to read the numbers out. I'm going to ask the people online if you can grab a piece of paper and write the following down. She has written a $200,000 purchase price with 5% down and a 25-year amortization. So that is currently a mortgage of $190,000 plus 3.6%, which is the mortgage default insurance rate. It's sad that I know what that means. Which means a mortgage of $196,840. They would be paying at a rate of 2.54%, which would be a monthly payment of $885.71. But they need to qualify at 4.64%, which is a mortgage payment of $1,104.83, which is the same as if they a $219 a month difference, which is 2.47% higher than the contract. So Deborah, what would that equivalent, if you did this payment amount at 2.54, what would be the mortgage amount they're qualifying for?
I didn't do that, but I'm going to show you how it has an effect on.
Because that's how my brain goes the other way.
Yeah, no. So
My brain says, I want to know how much they have to qualify for to buy a house that costs X. And what's the difference? So if they're going to buy a $200,000 house, they technically need to qualify to say buy a 225 house. I don't know.
Didn't have a chance to run those numbers backwards, but what I was working with, I was thinking of who's a client of mine that this is a typical first-time home buyer purchase, 200,000, 5% down, 25-year amortization. Often the monthly income is somewhere around, if there's two of them, if they're lucky, they might have 60,000 in income between the two of them. All other things being equal, it's hard to do that and write at the same time. I'm just looking at the effect that the difference in qualifying payment versus the actual payment is, how it affects their total debt servicing and gross debt servicing, because that's what it comes down to for us, right? Do they qualify or not?
Yearly or monthly?
Yeah. Sorry, didn't get the rest of it.
$5,000 a month.
Okay. Whether it's one person or two people. Thank you, Mom.
We need more mics, but in the meantime.
Thanks. Okay. That's what I need is more out there.
I know we're well enough to do that.
I still love you. It's okay. All right. Where did I get to? Okay. So the GDS, TDS effect. So if we have, this is the payment at the contract rate of 885.71 over 5,000. The total effect it has in GDS and TDS is roughly making up about 17.7% of whether it's gross debt servicing or total debt servicing. That doesn't matter. when we change that to the qualifying rate and a payment of 1104, 83 or 84 over 5,000, it now has the effect of 22.1% of what they have available for their debt servicing. That's a pretty big increase, especially most first-time home buyers are near the limit anyway. So that's a 4.5% difference. If you have someone with a TDS that's running at 38% under here, under this one, the qualifying rate, the contract rate, if you add 4.5% to 38, you're now at 42.5. Very likely they will not qualify because what's the standard maximum total debt servicing? 40. So someone who was previously pre-approved under contract rate or approved with CMHC or Genworth or Canada Guarantee under the contract rate, and then they make a change to their purchase, and they're now having to add 4.5% into that debt servicing, they may lose their house. They may lose the deal.
So what does that equate to? That example that you said 200,000.
Yeah.
Approximately what that now qualifies for.
I didn't have a chance to go back and calculate that.
They can't hear the question.
Oh,
Sorry, just you can repeat it.
so Christine, repeat it again to me.
So if that was based on, say, some 200,000,
Yes.
approximately what would that amount be? They now be qualified for.
So Christine's question was, if that's what they qualified before, 200,000, now they've had a change, what would they now qualify for? It's about 50,000.
Depending on
Right. Between 40 to 50,000 less, 160, which then totally changes the type of market that you are taking them to look at. And I did another one at 300,000, and it's not much better, and a higher income for them as well, and still same results. It changes. It adds about 4% to the total debt servicing, but the key factors are what is their debt servicing before you start, what is their income. If they're already comfortable, no problem. And again, we're only talking about the 5-year fixed rate. As Darren and Darlene had already mentioned, anything that was less than a 5-year fixed or a variable rate, they already have had to qualify at the board rate, which is 4.64 right now. And that could change given some of the information Darren was sharing about the cost of funds going up. What that really means is rates likely have to increase. Right, Darren? He's shaking his head yes. Any other questions on this then? If the first-time home buyers can't buy, then what happens in the market? Has a ripple effect, doesn't it? Is that good enough for you?
That's awesome. Okay. I'll let you take that out.
There you go.
Thank you. Okay, so we've had a couple of questions online, and I've tried to answer them. So we understand that it's difficult to follow the math that she's doing online. The long and short of it is it was really just a visual representation to let you know that they're going to qualify for less. Okay, and depending on where your buyer or seller who's about to be a buyer is in their debt servicing. So think about when you've been out shopping with clients and you're like, they qualify for 225, let's say, and they're buying at 223, and you literally cannot cross that 225 mark. In most cases, they were probably pre-approved first-time buyers at the fixed lower rate, okay? If they have 5% down, there's not a ton of people that are in the financial position as first-time buyers necessarily, I think I'm fair in saying that, who are qualifying at the benchmark rate for the variable. That's not the normal scenario. So if you're working with buyers or if you have sellers who are also planning to purchase at the top of their qualifying range, it is essential that you get them requalified. If you have a seller who's selling their $350,000 house and they're going to buy a $450,000 house, but they told you they're pre-qualified to $600,000, they're probably fine. But you'd still want to get them checked. If they're buying at $350,000 and they qualify for $350,000, unless they have 20% down, they're not qualified for $350,000 anymore. Okay? Does everybody understand the significance of how this affects your buyers and sellers? Yes. Okay. So now let's talk about some opportunity here, because there's the other side of this, which in the end, long term, we're going to have clients that are more financially stable, that are less house poor, and are less margined to the 9th degree, ultimately. Does it suck at the moment? Yes, it does. Let's just be honest about that. Let's move forward. The rollout and the short time frame is not helping anybody, okay? And this ambiguity about long closings and changing and going back to the insurer and all of those details are nowhere in the randomness that you're finding online. The one thing that I very strongly recommend that you do is, if you have questions, is to reach out to a professional that you like, trust, and respect to get the answers versus using the Google, because you're going to end up muddled and not giving the right advice. And the best advice that you can give any of your clients, I'm sorry, Al, can I just ask you to stop? Thank you. Is to have them speak to an actual financial professional. We're not financial advisors. Our job is to understand that there's a situation that requires professional advice and ensure that your clients are partnered with the right people to give them those answers. Alicia, you had a question?
Does this affect just federal, or does it affect provincial lenders as well?
So you're asking me about credit unions? Because that would be the only provincial lender that I can think of. So the question is, does it affect only federal lenders or provincial lenders? This is a federal rule that has come across, so it affects all insured mortgages. As to the specifics and minutia of a provincial lending body, my understanding is that they still insure through the federal programs, so I think the answer is there's no way around it. Credit union put out a notice yesterday, said Brenda. So it is really important that you understand this. So the opportunity that exists for you is, number one, to be in the position of giving great advice and not losing clients. You will lose clients if you do not get in front of this, because someone else who is more informed will inform your people. You being the trusted advisor and the respected person who's putting your clients' interests first and having that conversation with them will absolutely solidify your business, and it will create referral business for other people who are unhappy with the representation they currently have and whose partner or realtor did not inform them or ask them these types of questions to help them move forward. There's also a huge opportunity here to work with any clients who are in any way interested in getting into the rental market. Because there's definitely going to be a pause potentially in the first-time home buyer and a slowdown in some of the original first-time home buyers. We have no measurable idea. It may not make a huge difference, but there's going to be some who need to wait, or they don't like what they can buy at the new rate versus what they qualify for. That's a different conversation. Because we've all have the clients that watch too much HGTV and are first-time home buyers with very starting jobs but would like to live in a palace. Like, we all have those clients, right? So the other piece of it is to be having conversations with your clients that do have 20% down and have them getting into buying semi-detached or single-family homes that could make great rentals with 20% down, because then they're at the posted rate. There's an opportunity here to create that investment portfolio for clients. Does everybody see that? Okay. Or to work with clients to put them with their financial advisor. Maybe they were going to put 15% down and they actually have access to the other 5%. It just means jigging it around and having that conversation. So you being informed and being able to go forward with your clients is going to be the difference that allows you to turn this into the agents that thrive in this change versus the ones that are sitting there wondering why their seller is now homeless. Al, you had a question.
My own side. One thing to keep in mind on this is, with clients, you're dealing with their total debt service a lot. Someone I was talking to, they had a car loan of $488 a month, and they had, I think it was 11 months left. They already talked to their advisor, who said, well, we'll refi your car loan to a 36 month dropped the payment from 488 to about 200. So it really helped them on their debt service ratios. So you're going to have to warn people that they got to be a lot more open with their advisor, and it has to be a total review of their financial situation, because they could still make that payment of 488, but their commitment would be 166 or something like that. So they'd be in a good position. So we just have to all be a little bit smarter and make sure we're talking about some of these other items that come into their debt service ratios.
Thanks, Al. That's great advice. I think one of the other things I just want to mention is I've heard from various agents over the years that they don't ask questions about their client's mortgage, or they're not involved, or that's the bank's department. And that's great if your clients are partnered with really great people. But we all don't have every single client with these great people. That's the reality. And you know that in some cases you've never spoken to their mortgage person. They might have sold shoes yesterday and now they're selling mortgages. You have no idea. You cannot assume that they are actually getting quality advice from that person, or that they haven't just done their pre-approval online and never actually spoken to a human or submitted a document or done whatever. So the concept of you being able to stay out of the financial aspect of a real estate transaction with something like this happening, in my opinion, is a breach of your duties. And you have to, at the very least, ask the questions. And then your people are going to do what your people are going to do. But for you to sit and assume that the general consumer has figured out what this announcement means, when half of the industry doesn't understand what it means, they are all going to think that their pre-approval that they got before stands. So when you're having this conversation with your clients, I really am not recommending that you call your clients and cause this huge panic. And I'm not asking you to go towards your clients in a very negative way. I'm asking you to go to your clients with a perception of contribution, to say, this is the information. I am now much more informed on this, and it's my responsibility to make sure that I look after your best interests. So let's have a quick conversation about where we're at with your listing or your pre-approval, or when did you get it, or how close are you to your debt servicing? Please call your financial person and let's make sure we're good to go before I sell you out of your house. Okay. Does anybody have any other questions for our wonderful RBC people that are here, or for me as broker?
I have a question.
Yes.
So I have a client, it's Leanne.
Oh, Leanne.
I have a client that wants to purchase a house in December, and she's been holding off because of the October 16th rule, getting the new interest rate by October 16th or whatever. Would you recommend that I go to my client and say, hey, you really need to get that firm offer in now instead of waiting to December, because your payment is going to go way up? Is that something you would recommend?
Let me clarify very quickly. Their payment will not go up. They will pay the lower rate. They have to qualify at the higher rate. So what is important is, if your client is planning to buy, I'm just going to say 250 because it's an easy number to work with. If your client is planning on buying a $250,000 house now, and they only qualify for $250,000, then if they want to buy a $250,000 house now, they need to buy it now. Because if they wait until December, unless they come up with more down payment between now and December, they will be buying a $210,000 house in December. They will still pay the lowest amount, but they must qualify for the higher amount. Absolutely. Wait.
The only point that I want to clarify with that is, if they waited till December, yes, it's the qualifying rate, and that's all good. If they want to do it right now, it needs to be insured approved. Bank approved is the given. It needs to be insured approved prior to October 16th. So if the client that you're mentioning right now wants to buy in December, you have an advice conversation, she decides to put in her offer now, it's accepted, and you get your bank approval, you get your insurance approval prior to October 16th, it needs to now fund by March the 1st. And if it does not fund by March the 1st, they will be subject to the qualifying rate. So you want to make sure you're clear on that as well.
Close. Pay the money. Yeah, funding, you guys, we call it closing, you guys call it funding. Yeah.
I'm just trying to confuse you guys.
Yeah. Okay, hold on. Hang on one second. I'll just finish with Alex here.
So if it closes after March the 1st, if no changes are made to that agreement, there's no amendments done, they will still...
Depends on insurance. What?
Right, so if it was before October 16th,
No.
October, oh.
Changes come out October the 3rd. Sorry. So just to clarify, so if they have their approval prior to October 3rd, doesn't matter what they do. Okay, so it can fund after I almost said 17th. Approved from the insurer, it can fund after March the 1st. If they make changes to the application, then it goes through the new process. Yep, 16th. Yep. If the closing date is set for March 2nd, or if something, now what everybody needs clarity on is what happens if you have a closing date of February 28th and something changes into March. That's where everybody is still unknown because we still have the approval. However, if you do a deal today and the closing date is set for March the 2nd, new rules. Even if it's approved, insured approved prior to October 16th. And that's on your template that we handed out as well, that if it does show that if the closing date is after March the 1st.
Okay, Al and Alicia, sorry.
In this short time frame we're dealing with now, if the deal is signed before October 16th, bank approval, take that as a given. You just said that it has to be insurer approved by the 16th. I thought it was if it was submitted prior to the 16th.
Hang on.
The insurers are going. Sorry, that's what I mentioned earlier. That the insurers are going to work with that based on the influx. So they're going to hopefully look at the intake date. That's what they explained to me. I say insurers, but it was CMHC I met with yesterday. That they're going to actually look at the intake date. So if the intake date is October 15th, but because of the influx of applications they're getting, they only get to it on the 17th. They're telling me they're going to go back to the 15th and use that as the intake date. And that's an internal systems issue for them.
The long and short of it, though, is if you submitted a deal to your financial institution on October 16th, you are absolutely running the risk that it may fall under the other rules. So I would not use that as your go-to. Alicia, I apologize.
Okay, so I think my question was just answered, but what I was going to ask is where today is October the 7th, takes approximately 5 business days for an approval to come through, and they're not open on the weekend, and Monday is a holiday. So therefore, in order for an offer to be approved before the 17th, the offer needs to be in today and submitted.
Yep. Everybody go. Everybody go. Everybody go. So the question is, well, it depends because it would depend on the lender. RBC approves in 24 hours. Joe Blow lender, 24 to 48 hours. Yeah, but it's supposed to go. But if we submit it on Tuesday the 11th to RBC, the odds are you'd get through the muddle. If you submitted on Tuesday to Joe Blow, the mortgage broker, I have absolutely no idea what your turnaround time would be. So the end result is that you need to, especially for clients that you're working with right now that are in that pipeline, that's your number one priority, okay, is, not dragging conditions. If you're writing a deal today, you want to be all over those condition dates and getting stuff submitted as quickly as possible. If you have clients that, as Brenda Kay said, she's out working with active buyers at this moment, unless you can guarantee that you're going to write that deal and get it submitted by X date, you still need to have that conversation to create that sense of urgency, and if nothing else, to make sure that your client is fully informed about their choices. It's not that you're trying to push a client into writing now. It's that they need to understand that if they do not, this may affect their purchase price. Maybe it won't. Excuse me, maybe they're extremely well qualified and not shopping anywhere near their maximum, right? The long and short of it is you need to have a conversation with your clients and with their financial advisor.
So in a nutshell.
In a nutshell, I'm repeating Alicia.
In a nutshell, if you submit a deal now and Monday, in order to ensure that it is submitted and your conditions are met, you better be doing city, because Vellum Septic better wait for water test, and that takes more time.
CMHC, I don't believe, needs water tests to approve.
That's true. Okay.
They do want? No, they don't need them to approve. The financing approved. You don't need the rest of the deal. You need the financing approved through the insurer. Brenda?
You can go through the whole process, mortgage everything, and no water test.
Yeah, no,
The lawyer needs to confirm that there's potable water on closing. So that's why you make it a condition of a purchase and sale agreement. Yes, but it would not hold up a financing clause.
no, your financing approval through the insurer has to be back in order to do it. You might get your septic test the next week. That doesn't matter. Your date stamp from the insurer is prior to the 16th. Is that correct, Darren? I'm sorry? Their stamp is the godfather right now, Alicia. Yes, that's correct.
Just to clarify, we are open Saturday. We do have an adjudication. I don't know about Saturday. They're open. We use our Western Center. So if the deal comes in the evening.
So Darren is just, so depending on the lender, Darren's just saying with RBC that they work different hours for our online people so that you can move things more quickly. So we do have a question online saying, how does this affect refinancing?
Well, right now we can only refinance. Right now you can only do 80% refinance anyway. B lenders can do or could do up to 95%. Some could do up to 95% insured. They can no longer do that. Some can, some can't. We noticed, or I got an email from somebody last night that one insurer has actually pulled out, or sorry, not insurer, one institution has pulled out of refinancing altogether, and another one has actually increased the rates. So I don't know who asked the question, but refinancing through a traditional lender anyway, you can't do it up until, or you can only do it.
We're not going to talk the divorce thing because we're not going to worry about that one right now. Okay. Does anybody else have any other questions? Did I answer your question, Holly, on the October 3rd and October 16th? No. Okay, so let's just summarize. So everything that was written and submitted to the insurer prior to October 3rd, and Darren's going to tell me if I'm wrong, is under the old system, and it can close whenever it wants, and it could be calculated at the discounted rate, and that's fine. Is that correct? Prior to October 3rd.
However, if there's an amendment.
Okay. From October 3rd to October 16th. Am I reading something?
Well, application before October 3rd. Application, we can send these out. Yeah, we can email it out. Application before October the 3rd, you're getting the contract rate. So whatever that may be today, it's the sale rate. Applications between October the 3rd and the 16th with a funding date prior to March the 1st, you're getting the contract or the sale rate. If the application is between now and the 16th of October, but with a funding date after March the 1st, they're getting the qualifying rate, which is the 4.64 currently.
Does that help? There will be an email with this that's going to go out. Yeah, our poor online people don't have the piece of paper in front of them. Okay. Okay, we'll get that emailed out to all agents. Okay, so everybody good? Yeah, just in that's thank you very much, Susan. Yeah, there's also an opportunity if you have buyers in your pipeline that have been sitting on the fence that really could pull the trigger. And you know that they're margined to the top of their debt servicing. This is an opportunity to get them out shopping this weekend, in the beginning of the week and get them into a house. This is going to be an attitude decision as to how you deal with this. You're going to be, if you choose to look at this as it defines me as the expert and I'm going to provide value to my buyers and sellers, then you are going to come from a place of contribution. You're going to be a trusted expert and you're not ever going to lose a client, and you're going to actually gain referrals because you're clearly going to set yourself apart from the competition. Steve.
In terms of trying to study this more in depth, and trying to try and study this more in depth, is there a source? Is there a government website, or is it all? It's all just hearsay at this point. Somewhat. It's in pieces.
You can.
Oh, I can speak apparently. Darren is afraid of the mic. Let's just.
I can share the RBC economics, which is a very quick summary that came out literally shortly after the announcement. So I'll email that PDF when I email the template that you guys have in front of you right now. But the faster we get information, so CMHC is meeting today, they should have more information for me.
They're going to share with us as we get it, right? As it will be disseminated out to you. But again, it's having the conversation with your clients and taking the time to be here today, to reach out to your fellow peers at KW who are not able to be here. Don't necessarily try to explain it. If you're not comfortable with it, send them back to me, send them to Darren, send Darlene, Deborah, anybody, and we'll do whatever we can to get you the information. Irwin. Okay.
I think everybody has to, I don't want to sound, but I think everybody has to stop with negative thoughts and put a positive spin on it. This is a perfect opportunity for all your past clients.
Yep.
And say, you even heard about the clients that aren't even on your on the
So what Derwin is saying is that this is, what Derwin is saying, and I thank you so much for saying that, Derwin, because I was trying to get there, but my brain went in 50 different places. Squirrel. This is a positive thing if you choose to look at it that way. There's going to be lots of people grumbling. There's going to be lots of social media grumbling, lots of realtors grumbling. Those are the realtors that are going to grumble anyway, no matter what was happening. What Derwin was saying is this is a huge opportunity, and thank you for going there, Derwin, in the sense of reaching out to all of your past clients to be of service, of value, and having those conversations. Maybe they'll just be happy to talk to you, that you took the time to call them about that. Maybe they're going to say, oh my gosh, now's my time to buy an investment property. Who knows? For everybody who's about to start bold, this is the perfect opportunity to be having those calls and having that conversation with people and anybody you know to make sure you're providing that information, okay? So again, be of service to your clients. Please don't stick your heads in the sand and assume that this is only the seller's or the buyer's responsibility to look after their money. It's our responsibility because we are their advisor, and if we know about this and don't tell them, we're not doing any good for anybody. And Kim says it's a great way to create a sense of urgency. And Holly says we need to buy more mics. And yes, thank you. Susan.
I feel it's a good opportunity too, because I hate when I'm not in control, but when it comes to but when it comes to clients that don't, you ask the question if they're pre-qualified, but you don't know their mortgage specialist. You don't know who you're using. This is a soft touch to say, I have some great mortgage specialists that I can put you in touch with that know all about the rules and can get you the approval that you need.
Thank you. Awesome. So I think I think everybody here, and certainly in our family of KW. Oh, Alicia is like super excited about something. She gets excited about stuff like this. I'm just repeating.
So back to what Darwin just said, and back to what Susan said, I have a great opportunity.
Hold on. The enthusiasm has to come from Alicia.
Yes. So back to what Darwin just said and back to what Susan just said, contacting your sphere of influence or the people who you have already sold houses to inform them, okay, this is what is taking place. When you are up for renewal on your mortgage, and back to what Al said, talk to your financial advisor to look at your whole debt service ratio and try and narrow that down a little bit so that later, after the 5-year term that you're currently on is up, that it will free up a little bit of money so you're not at the end of the month struggling.
Well, there's also the, it does, it's also the opportunity to take it from the other perspective to say, when we're selling your house in 3 more years.
That's a better example because it does not affect current clients. Does not.
No, not someone who already owns a home. No, not, no, 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 no. No, there's no new application on a refi, on a renewal, right? So there's a refinance and a renewal. You're thinking of that they're the same thing, and they're not, correct? Yeah. Refinance is you're asking for more money. A renewal is a total, nothing about renewals. But it is yeah, well, yeah, they don't need to go through this procedure for a renewal. So we're not going to have 1 million Canadians that are homeless on renewal, okay? So just be very clear about that. But it's still an opportunity to have a conversation to say, when, you know, in 3 years, tick, 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 because, you know, you're only allowed to live in a house for 5 years, just so you know, that's how I eat. So when the 5 years is up and we're going to sell your house, let's make sure you're in the right financial position to allow for that to happen if we're going to increase your mortgage. Margaret. If they want to change, they go shopping. That's what you're asking, if they're shopping their mortgage. So if they don't renew and they go shopping.
Correct.
Yes.
Great question. Great question.
Does everybody understand what Margaret said before I read the question online? Does everybody understand what she's saying? Yes, nods, yes. Okay, the question online is, will this be a long-term thing? Is it under the impression it's a test? How long will it last? My answer would be forever. Yeah, it would be like income tax was introduced in the First World War to pay for the war. Yeah, you're thinking of the stress test? Yeah, yeah, but I would say the odds of it being repealed are 0 to 0 to 0.
I think it's a brilliant way to be able to know in the future that they're going to be able to finally increase the rates they've been threatening to do for the last 15 years.
Something about increasing the rates. Now they're going to be able to increase rates that they've been threatening to do.
It'll happen. It's just a matter of when.
Yeah.
To be honest with you. And that's what I mentioned earlier around the cost of borrowing. There's no choice. And that's the
you were speaking banker, I'm going to be honest. At the beginning, it was a little bit bankery. I'm just being honest.
The government is moving the risk off of their own plate as much as they can. And again, this being the 6th change, they continually move more and more off to either financial institutions or ultimately the client, that the homeowner. And that's what they're trying to do with this change as well. So there's no choice but the cost of funds or the mortgage rate to be increased. It's just a matter of when. And right now, there's no imminent rate increase. Let me clarify that. But it will happen. We know that. It just.
And they want to make sure they can pay the bills. Okay. So one more comment from Steve. And, oh, Wendy's online. Yeah. Okay. Wait,
Mine's kind of more of a, I hope you don't mind, mine's more of a general discussion question, but, you know, obviously you said the 6th change that the government has introduced in the last how many years? In the last couple of years? Okay. I'm just curious if what your personal feeling about how the government is treating the mortgage markets as a whole in relation to the different areas in Canada, because obviously these changes were put in place to kind of quell and subdue the kind of inflations in Toronto and in Vancouver in particular. Why is there not a regional or provincial aspect to this change?
He's waiting.
It's actually a great question, and I asked the same question of CMHC yesterday. They said logistically they just can't do it. So whether or not that's the government answer or whether or not that's the insurer answer, I'm not sure. But you're absolutely right. We saw some changes with Vancouver in particular, with the non-resident tax in, I think it was June, and that wasn't small. That was pretty significant. Their first month that went into play, the purchases out there dropped drastically, but they're saying they would have anyway. So they saw that trend that it was, but they know that it works somewhat. So then they now have a non-occupancy additional tax out there. So, you know, they're going by first, put your hand up. If you own this house and you don't live in it, put your hand up because we're going to charge you more money. How many people in here would do that? Not very many. So now they're going to the power corporation out there to see what the minimum amount of power it is that runs through a house if it's occupied. And if it's not, then they're going to have that. And I don't know what that additional tax rate is going to be, but that's the additional piece that they're doing in Vancouver. So we continue to lobby for regional changes and regional, whether you want to call it underwriting or regional policies. It's the same way in our world with our lending policies that from time to time we'll put on a special in Atlantic Canada that the rest of the country doesn't have. So we continue to ask for that. We continue to lobby for it, in particular in our market around first-time home buyers, because it's a tough market to get into if you're a first-time home buyer. And now with these, that's just going to be that much worse. And you know, that's the tough part, but it's on the radar 100%.
Great time to become an investor, absolutely. So they don't know what a monoline is.
A broker. Sorry.
Thank you. Okay, Wendy, you had a question? Remember I said speaking banker? That was it.
To simplify things, because that's the way my brain works, when a client is asking, why is this happening? I'm assuming, correct me if I'm wrong, that it's a risk management in order to protect the consumer, homeowners, for future should rates increase. Is this basically what this is?
Da-da-da-da! Points for Wendy. Yep, she got it. Okay.
It's around consumer debt. That's the, because again, if it was to protect the bank, I'm pretty sure we, not just us, but all the financial institutions would have been involved in the discussion.
So there's some comments online about, you know, going to Ottawa and whatever, and that's where I'm going to bug you again about getting involved with your political action committee at NSCR or getting online and being a participant with Korea, because we do have an extremely powerful voice in Ottawa. And just so that you're aware, the PAC committee is actually going to Ottawa next week. And what that means is that the PAC committees from all of the Korea committees all across Canada, there'll be, I think it's about 10,000 realtors land on Parliament Hill and all have meetings with all of their MPs and regarding issues. And this is obviously on the agenda for everybody. So you do have an opportunity to, oh, thank you, Rebecca. Can you send that out as all agents for me, please? I will allow a non-management person to send something out on all agents if you don't mind. Thank you. So first of all, I want to thank everybody for taking the time today to participate online or to come and join us live in person, and to especially thank RBC for their time and energy and their extreme commitment to us at Keller Williams to be available at such short notice and provide such great information. So thank you very much. Okay, so I think you were doing a draw or something too, weren't you? Oh, by the way, you brought treats. So everybody, business cards in the thing. We'll write down the names of the people that are online on a piece of paper if we could. Chelsea, can I just ask you to tear pieces of paper? No, but I have to tear them to tie them and put them into the thing. Oh, sorry. I'm so sorry. Okay. You can write my name down too because I don't have a card on me. Thank you, everybody. If you have any other questions, let us know.
Hi, everybody. While I have your attention, November 23rd, put that in your calendars. It's the fourth Wednesday of the month. RBC has been so gracious to bring in Canadian Mortgage and Housing on that day and to go over the report. So November 23rd at probably around 10:30, there will be an email, but November 23rd in the morning, Canadian Mortgage and Housing will be here. Thank you.
Thanks, guys.